Hey everyone, welcome back to Corporate Decoder. Today GNK just filed an amendment to a shareholder rights agreement and I am seeing a strategic shift that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. It looks like Genco Shipping is tweaking its defenses against a takeover. And this comes at a really interesting time given recent takeover chatter. We are looking at an 8K filing from Genco Shipping Trading Limited, a company involved in marine shipping. They recently made an amendment to a shareholder rights agreement. Think of this agreement like a company's poison pill designed to make it harder for another company to buy them out without paying a fair price to all shareholders. This filing specifically details the second amendment to their shareholder rights agreement. The original agreement was put in place in October of 2025, with a first amendment in November of 2025. Now, here in May of 2026, they are making another change. The key point of this second amendment is to effectively undo some aspects of the first amendment. So, the original rights agreement is now back in full effect, with some modifications from that first amendment being removed. Why would they do this? Well, it seems Genco's board decided that the threshold for triggering these shareholder rights should be set at 15% of the company's outstanding common stock. Previously, that threshold might have been at a different level due to the First Amendment. This change means that if any single entity or person acquires 15% or more of Genco's stock, the rights agreement will be triggered. This is a pretty standard defense mechanism. It is intended to prevent any one group from gaining control of the company without negotiating with the board and offering a premium price to all shareholders. The goal is to make sure that any potential buyer has to consider the interests of all investors, not just accumulate shares quietly and then demand a higher price after the fact. This filing also lists key securities like common stock and preferred stock purchase rights. These rights are what get activated when the takeover threshold is met. They essentially give existing shareholders the right to buy more shares at a discount, making it more expensive for a hostile acquirer to take over. Now, this move by Genco Shipping comes at a really interesting time. We have been seeing news lately about Diana Shipping Inc. making a tender offer for Genco shares. They launched an offer to buy Genco shares at $23.5 each, and they are taking their offer directly to Genco shareholders after Genco's board refused to engage. This filing, making it harder to just buy up shares without a proper negotiation, could be seen as a direct reaction to this unsolicited offer. It is Genco's way of saying they want to protect their existing shareholders from a potentially lowball offer and ensure any deal is in the best interest of everyone. The original rights agreement, the First Amendment, and now this Second Amendment all point to a company that is actively managing its shareholder structure and potential takeover scenarios. The board is emphasizing that this is not meant to deter fair offers, but rather to provide them with time to fulfill their fiduciary duties to all shareholders. Looking at their registered securities, common stock is traded on the New York Stock Exchange under the ticker GNK. They also have preferred stock purchase rights registered. Also on the NYSE, this indicates a standard structure for a publicly traded company. The decision to adjust the beneficial ownership threshold to 15% was actually flagged in a preliminary proxy statement filed back in April of last year. This suggests that the board has been considering this change for a while, and it is now being formally implemented. It shows a proactive approach to corporate governance and defense. The board's decision is based on shareholder feedback and an ongoing assessment of the situation. They believe raising the threshold to 15% is in the best interest of the company and its shareholders. This aims to prevent opportunistic takeovers and ensure that any change of control fairly reflects the long-term value of the investment. It is important to remember that Genco Shipping plans to allow all shareholders to realize the long-term value of their investment. This poison pill mechanism is designed to give the board leverage in negotiations, ensuring they can consider any proposal thoroughly and acts in the best interest of all shareholders. It is not intended to completely shut down offers, but to make sure any offer is a good one. This section of the filing is called Entry into a Material Definitive Agreement. This tells us that the company has officially signed a significant new agreement. In this case, it is that Second Amendment to the Shareholder Rights Agreement. This is material modification to rights of security holders. This item is directly relevant because the amendment we discussed changes the rights of shareholders, particularly in the event of a takeover attempt. The information from item 1.01 regarding the amendment is incorporated here, making it clear that this is a significant change for all security holders. This section covers financial statements and exhibits. While the core of this filing is about the rights agreement, it also lists the attached exhibits. The key exhibit here is Exhibit 4.1, which is the actual text of the Second Amendment to Shareholder Rights Agreement dated May 1, 2026. This is the document that formalizes the changes we have been discussing. Exhibit 104 is the cover page interactive data file, which is standard for electronic filings. Finally, the report is signed by Peter Allen, the Chief Financial Officer. This shows official approval and filing of this amendment. So, what does this all mean for Genco Shipping? They are clearly shoring up their defenses against potential hostile takeovers at a time when there is active interest from outside parties like Diana Shipping. By increasing the threshold for triggering their shareholder rights agreement, they are making it more difficult for an acquirer to gain a significant stake without drawing attention and facing a more structured process. This is a common strategy for companies looking to protect their shareholder value and ensure they have the negotiating power to secure the best possible outcome for all investors. It indicates a company that is being run strategically and is prepared to fight for its shareholders' interests. The risk I am watching is how this defense impacts genuine offers that might be beneficial. What I'm actually looking for is whether the board can leverage this strengthened position to negotiate a truly premium deal, or if it just becomes a hurdle to fair offers. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please like, subscribe, and join our Discord community in the description.